In this lesson, we are going to cover what currency pairs are, which of the many currency pairs do we actually choose to trade and focus on, how to read a Forex quote, and then we're going to finish off by looking at what pips are and how we measure them, because this is a vital part of the risk management process. So, as a Forex trader, the first thing you'll need to learn about is your product, right? And that is currency. Now, while there are lots of currencies that you can trade, most active traders focus on the 8 major currencies of the world: the United States dollar, the euro, the Japanese yen, the Great British pound, the Australian dollar, the Canadian dollar, the Swiss franc, and last but definitely not least, the New Zealand dollar. Now, currency symbols, they always have 3 letters, where the first 2 identify the country, and most of the time, but not always, the third letter represents the name of the currency. So take the New Zealand dollar for example, NZD. The NZ stands for New Zealand and the D stands for the dollar. Pretty simple, right? So as a currency trader, you may be presented with the opportunity to trade more obscure, exotic currencies such as the South African rand, the Mexican peso, or the Thai baht. Now, I would strongly advise that you stick to the major 8 listed here, as these currencies have the highest trading volume in the FX market. And high volume means that transaction costs are generally lower, and the more people are trading those currencies, leading to higher liquidity, which is vital when you need to exit a trade. There is simply no need to risk your capital taking a position on those high cost and those low volume exotic pairs. Now, an individual currency, it does not have an absolute value. So the only way that you can value them is you have to compare them to that of another currency at any given time, so are therefore always quoted in pairs. A currency pair is simply the quotation of the relative value of a currency unit against the unit of another currency, right? You always have to pair them together. Just on its own, there's no way of putting a price on it, essentially. So, an example of a pair would be AUD versus USD. So the Australian dollar versus the US dollar, which is commonly referred to as Aussie dollar. So if you were to buy the Aussie dollar, in trader talk, you would say that you were going long the Aussie dollar. And another term that will become a common part of your vocabulary now that you are a trader is bullish. So you say that you are bullish on a currency pair, or whatever asset class you are talking about, if you think it is going up. So when you buy this currency pair, Aussie dollar, you would be buying Australian dollars while simultaneously selling US dollars. So this means that you would profit from how much the Australian dollar appreciates, so it goes up in value in comparison to the US dollar. And if you were to sell the pair, this means that you are going short, and you would say that you are bearish on a pair if you think it is going down. Now, I know if you're probably a bit new to trading, it can be a little bit confusing if it's the first time you've heard some of these terms. So an easy way to remember the difference between bullish and bearish is that when bulls attack, they swipe upwards with their horns, and when bears attack, they swipe downwards with their paws, alright? But anyway, if you were to sell the pair, Aussie dollar, you would be selling Australian dollars while simultaneously buying US dollars with them, right? Now, if that can be a little bit confusing, fortunately, your broker will take care of this, the simultaneous buying and selling at the same time. They'll take care of that so that you can simply focus on the pair as a single trading instrument, just like a stock. So, on your execution software, you will literally either just click buy or sell on the pair as a whole. So they make it super simple for you. Now, don't worry if it seems a little bit confusing at this point, because we're going to cover specific instructions on executing trades in the later lessons. Now, paired up in every possible combination, the major 8 individual currencies, they deliver a total of 28 tradable currency pairs. And of these 28 pairs, those that contain the US dollar, those are referred to as the majors. And the remaining pairs that do not contain the US dollar, they are commonly known as minors or crosses. Now, you may hear many of the major pairs referred to by traders with certain nicknames. Australian dollar versus the US dollar are simply Aussie, pretty simple. Pound dollar is often referred to as cable, and this is because back in the mid-19th century, before the invention of satellites and fibre optics, the exchange rate between the Great British pound, sterling, and the US dollar, it was actually transmitted across the Atlantic Ocean via a submarine cable, so this is what essentially traders refer to it as. But then when the euro was introduced not too long ago in the late 1990s, probably when some of you were actually born, traders simply upgraded the old cable to a state-of-the-art fibre optic line, hence the ingenious name, fibre. Then we have Kiwi dollar, simply as Kiwi, dollar CAD as Loonie, dollar Swiss as Swissy, and dollar yen as Ninja. Now, with the photon strategy, you will find that there is literally an overwhelming abundance of opportunity on literally a daily basis on even just one currency pair alone. So, if you want extraordinary results, it is highly advised that you narrow your focus onto just one or even a few pairs and really spend time mastering those. Now, we're going to discuss this in much more depth in a later module in the course when you start to put your trading plan together. But some of the main pairs that most traders in our community focus on are euro dollar, pound dollar, Aussie dollar, and pound yen. But yeah, don't worry too much about that just now. So when pairs are quoted, the currency on the left hand side is always called the base currency, and the currency on the right is called the quote currency. So the pound dollar exchange rate, this indicates how many Great British pounds can purchase one US dollar, or how many US dollars you need to purchase just £1. So the base currency on the left, in this case the pound, no matter what, it always has a value of 1. So for this example, if pound dollar is quoted as 1.3035, what this essentially means is that £1 is equal to 1.3035 US dollars at that point in time. So if you have some US dollars and you want to buy some pounds with them, you would have to pay 1.3035 US dollars for every pound that you want. Or the other way around, let's say that you have some pounds that you want to buy dollars with, then you would receive 1.3035 US dollars for every pound that you then sell. Now remember, when you're trading, if you buy the currency pair pound dollar and you go long, this simply means that you are buying the base currency and you are simultaneously selling the quote currency at the same time. So in simpler terms, if you go long pound dollar, you are buying pounds and you are selling dollars. So you would buy the pair if you believe that the base currency, so the Great British Pound, you would buy the pair if you believe that the pound will appreciate and gain value relative to the quote currency, the US dollar, and you would sell the pair and go short if you think the base currency, the pound, will depreciate and lose value relative to the quote currency, the dollar, right? So, in trader talk, buying a currency pair is referred to as going long or taking a long position, and ideally we want to be buying low and then selling back to the market at a higher price for a profit. So in that case, we expect the pound to strengthen against the US dollar. And then selling a currency pair is referred to as going short or taking a short position, and you can make money when the market falls. So in that case, we want to make sure that we are selling high and then ideally buy back at a later date at a much lower price to then lock in that profit. And we will short pound dollar if we expect the pound to weaken against the US dollar. Okay? Pips. Okay, so pips, they stand for percentage in point, and they are the unit for measuring the change in value between the two currencies. So essentially, pips are what we refer to in terms of the amount that the price changes. So when reading a price quote, a pip is usually the fourth and last decimal place. So 1 pip equals 0.0001. Now, it gets a little bit tricky because there are some exceptions to the rule, like the Japanese yen pairs, because they only go out to 2 decimal places. So in that case, 1 pip is equal to 0.01. Right, so you can see the subtle difference there. But it's just the yen pairs really that do that. So let's do a quick little pip quiz. If euro dollar rises from 1.1035 to 1.1040, how many pips has that gone up by? So pause the video now if you want to write that down. And the correct answer is 5 pips, okay? Pretty simple. Let's do another one. If euro dollar falls from 1.1035 all the way down to 1.1005, then that indicates what? a 30 pip fall. Yes, you are correct, hopefully. Alright, last one. If pound yen rises from 140.90 to 141.05, what movement in pips is that? Yep, it's a 15 pip rise. Because remember, Japanese yen pairs, they only go out to 2 decimal places. Now, most Forex brokers, they quote currency pairs beyond the standard 4 and 2 decimal places that we just looked at, and they now actually go to 5 decimal places on most pairs and 3 on the Japanese yen pairs, to give us that extra added precision in quoting those exchange rates. And these are referred to as fractional pips, which are more commonly known as pipettes or micro pips, and they are equal to a 1/10 of a pip. So if euro-dollar was quoted at 1.10352, then the 5th decimal place, which is usually visually displayed as a smaller number, that is the pipette, right? And which, in this case, that would be equal to 0.2 pips. And then if euro-dollar was then quoted at 1.10357, that would be an increase of half a pip. So, just to quickly summarise the key points we have covered in this lesson, we focus on the 8 major currencies: the US dollar, the euro, the Japanese yen, the Great British pound, the Canadian dollar, the Swiss franc, the Australian dollar, and the New Zealand dollar. Individual currencies don't have an absolute value, however, so this is why they are quoted against each other, and we put them in pairs. So we pair these 8 currencies into every combination possible, which makes 28 tradable currency pairs. But as I was saying earlier, with this strategy that you're going to learn, you will only need to focus on just one pair alone, or potentially a few pairs, depending on your trading style. But like I said, we'll talk a lot more about this at a later point in the program, when you start to build out your own personal trading plans. The major pairs are the pairs which contain US dollar, so euro dollar or Aussie dollar for example, and you will likely find that you will spend the majority of your time and focus probably just on these USD pairs alone, because they provide extremely reliable and frequent trading opportunities. And then the minor pairs are sometimes referred to as the crosses, and they are all of the remaining pairs out of those 28 that do not contain the US dollar. In trading, if we buy something, we say we are going long or taking a long position, and if we say we are bullish, then we think that that asset is going to go up in value. Because remember, bulls, they swipe and attack with their heads and their horns upwards, right? And if we sell something, we say we're going short, and if we say we are bearish on a particular asset, then we think that it is going to fall and depreciate in value, because bears swipe down with their paws, right? Pips are the unit for measuring the change in value between 2 currencies, which are usually the 4th decimal place, but there are some exceptions like the Japanese yen pairs, where a pip is the 2nd decimal place. Some brokers now quote currency pairs to 5 decimal places for added precision, where the 5th decimal place is called a pipette or micro pip, and this is equal to 1/10 of a pip. And you must develop a strong understanding of pips and how to measure them, as this is going to be the foundation of your risk management. So later on, you're going to learn the advanced concepts of risk management with an entire module dedicated to just this one topic.